you still like the market, even though we've come back a long way from the declines last month?
I do. I like pockets of the market. I think the market by itself is now fairly valued, so you really have to be specific as to where you want to go. But having said that, there's going to be a lot more volatility. We know that interest rates potentially might move. We know the administration is looking to put more tariffs on. Given that, and we've seen this story, especially in the last 6 months, I think if you focus on some areas that are undervalued, especially in terms of price to earnings and kind of potential growth. So building home products, companies like Masco and Fortune Brands, they really do well in a lower interest rate environment.
Why?
Because the consumer then has more access to capital, will put more money into their home, especially as housing prices have moderated now. Consumers now will want to put more into their home so that if they do sell, they'll get a higher appreciation for that. So kitchen cabinets, flooring, these companies are trading at 14 times earnings, really strong balance sheets, and really looking to kind of the consumer to go forward, especially with a full employment.
That means you don't think a recession is on the horizon?
I don't think we're going to get, if we get a slowdown, but I don't think it's a serious recession. And I do think at that point the consumer will focus more on their home and say, look, I'm going to enjoy the experience of putting into more things into my house than I think there. The other areas that I think that we like are companies like Disney and Interactive. Again, Interactive is Tinder, Match. That has secular growth going forward, really not specific to how the economy is going to do by itself. I think Disney is a special story. They're really focused now on getting into kind of the direct consumer business and also into the amusement park and the other part. So they have a great moat around their business. It's been a few years where Disney's been a dead stock, but I think management has reinvigorated this company.
Because of their new plans with the OTT?
Well, I think that's part of it. There's a whole part of the other Disney that people really don't, they forget. The whole Marvel, the amusement parks, the whole branding that they have. And if you think of Disney, every 8 years, they don't need to recreate their company. Their company already has content that has been created and money put into.
For a long time, it was ESPN that was really dragging things down.
It was, and
about what happened.
There was about a couple of years where the stock multiple just came down because ESPN was bleeding. Now ESPN is steadied, and now what they've done is segmented ESPN. They've segmented all their content and kind of looked at it as, hey, listen, you can have a different menu, and price point is much cheaper than kind of some of their competitors. So you've got a company that's positive cash flow, growing earnings, in a secular growth area where, yes, the economy could slow, but you're still going to get margin improvement.
What about IAC? I mean, is that a play on experiences, on love is in the air, millennials, everybody using the internet for all these things?
Absolutely. It's a combination of all those three that if you look at kind of the assets of that company, they're worth much more when the stock is. So if you take out Match and you take Tinder, which is growing, and you take out Venmo, which they also have, those assets are much bigger than kind of IAC's whole thing. So if you look at the market and you say, where do you want to be? Look at specific stocks at this point. If the market comes back as a whole, you've got some areas that you can buy in terms of great blue chips, but these are companies I like right now.
Why is IAC down? I mean, what's the market disagree with you on this?
Well, IAC's up if you look at the last 12 months.
But why do you think it's not fully valued as to where you think it should be?
Because if you look at IAC, Match is trading separately. So that's why you've got a kind of a discount to the value.
The Street hasn't figured this out? This is still like a secret?
It always gives it a discount until maybe they spin the whole thing out. And then really, Tinder hasn't gotten the full value as well. And then there are other pieces of IAC. But if you look at kind of as a sum of the parts, it's worth at least 30 to 40% more than kind of what it's trading on.
So they're just inviting an activist at some point to realize that value?
I think what they're going to do at some point is spin it all out. And then kind of focus on some of the other assets they have. That's kind of been the history of the Barry Diller companies going forward. But the secular growth in this company is so far and above the regular market growth that I think there's an opportunity here to buy something here on the cheap, regardless of kind of what the economy. People are still going to be dating. They're still going to be looking for that experience. And maybe they'll do more of it if the economy goes slower.
What about financials? I mean, we've been hearing for so long that the financials are the place to be from a lot of people.
So I look at it as kind of the barbell. You got the growth, secular stories, and then you got the value stories. We've been owning financials now for 3 years. They really haven't helped us. They haven't hurt us too badly either, right? But you're getting multiple compression. I mean, look at the big banks like a JP Morgan, Bank of America, even a Morgan Stanley. Balance sheets are really strong. Their dividends are going to grow double digits for the next couple of years. And really, at some point, I think the value is going to accrete to these stocks. I don't know when. If I
was
did,
going to say again, why has the market not figured this out yet? Because it seems like a smart play. Really intelligent people have been telling me this for several years, and it just hasn't caught on yet.
It hasn't, because you don't see that, quote, secular growth that we've had in the last 5 years, and, quote, the FANG stocks. Hey, what's sexy? I need to be in Amazon, and I need to be in, Salesforce and Workday and all these other stocks.
And the yield curve has disappeared. I mean, I look at what the ECB and the BOJ have done to their banks. I mean, the Topix Bank Stock Index is down 90% from where it was 30 years ago.
Right.
And from a value perspective, I agree, but I'm just worried that they're going to get stuck in this same sort of profitability situation where there is none because of what the central bank has done to the yield curve.
And that is a real fear, right? The fear, at least in Europe, you have negative interest rates, so that really hurts the banks. I think here right now, our yield curve's flat, kind of inverting at this point. So you really have to look at the banks to say, where else can you make money in our business? So JP Morgan or Morgan Stanley, to the stocks we like, they have a wealth management business. They have an M&A business that can support it. I think if you're just buying it on the yield curve, it's very hard to say, do I even get it close to a market multiple? And at this point, Morgan Stanley's trading just a little bit about book value. So you've got cheap stocks that I think have some intrinsic value to it, so you've got a base to it. It's not like you're buying them at 20 times earnings and saying, hey, I think these stocks are going to beat the market growth. Right now, they're put in this bucket, and they're, 13% of the S&P.
Right.
So they've really come down since '09. And I think there's also this overhang of a lot of people who went through '09 and said, I don't want to touch this sector at all.
Never again.
Right? I don't know what's going on in there. And, is the real estate sector, is the credit going to hurt us at this point? So I think you take those and you say, if these banks can keep on improving, I think if they get 6 to 8% earnings growth and you get a 2 to 3% dividend yield, and the multiple stays where it is in 10, 11 times earnings, a little bit over book, in 3 years, if we don't get a recession and we get a slowdown, you're still going to do much better, I think, than the market, than some of these 30, 40 time multiple stocks that are out there that we saw after '99 when the multiple compresses. They can trade at 10, 12 times earnings.
Yeah, you see all these IPOs and you start to wonder.